Okay, it's now time to talk about withdrawal strategies from various accounts. There are generally three major goals with respect to asset withdrawal strategies. First would be the tax efficient drawdown, trying to have minimal taxes throughout retirement. The second would be to be sure that the portfolios last throughout your entire retirement because of that longevity risk that we could face in the future, living beyond your life expectancy and having to have that portfolio continue to generate income. And then finally, of course, is legacy planning. Hopefully there would be assets that could actually grow or be maintained to some degree that could actually then go to heirs for their benefit. This next slide is pretty much self-explanatory. I thought it was a real good summary, though, of the different types of accounts, the features, benefits, and the downsides to each of those accounts. So we have taxable accounts, that's the brokerage account, tax deferred, meaning IRAs and 401k type plans, and then of course the tax-free accounts. And of course you have a copy of this PowerPoint, so I won't be in the way when you pull up your PowerPoint. But it's broken down by contributions, how things are taxed throughout the life of the investment, and then when withdrawals are made, how those assets may be taxed upon withdrawal. So real nice summary there. I'm not going to walk through this. You can read this on your own, but do read it because it's important to understand how each of these accounts behave. Now, the standard traditional method of drawing down is to go taxable accounts, then tax-deferred accounts, and then tax-free accounts, with I think the main idea being that you want your tax-deferred accounts, those assets being held in those accounts, to be tax-deferred as long as possible. And so your taxable accounts, being the least tax efficient, would be the ones that you would tap into first and draw down on those. Now, this is not to say that you wouldn't actually have a pro rata drawdown across all three accounts, or maybe even go for your taxable at a later time. Go for have tax-free first. So there are examples, and we'll look at those when we get into this, of when this may switch up. But the standard method is to have taxable and then tax-deferred accounts, and then followed by those Roth accounts, which of course you want to just accumulate assets for forever and ever and be the last accounts to be tapped into because they're tax-free, and hopefully you have high-yielding assets in those Roth accounts. So we have two cases that we're going to look at. They're both roughly $3 million. One is slightly above that simply because I had to add two accounts in order for money to be able to flow into those accounts. And if I didn't set up those accounts with some dollars in them, I don't know that it would work properly. So in case number one, I have $3 million in an IRA or a 401k plan, I believe. But either way, it's a tax-deferred account, $3 million. And then I have a taxable account and a Roth account, each of those having $1,000 in each of those accounts, just again to get these accounts established. The other case is where I have $3 million, but it's allocated evenly across a taxable account, tax-deferred account, and a tax-free Roth account. So we'll take a look at how things kind of play out in terms of planning when we have assets that are kind of two extremes. One is everything is in a retirement plan, and with the other case, we have an even set of assets across all three accounts. So let's go ahead and get started. Okay, so the case study is we have a person who's age 65 years old. He'll be retiring in 2 years and will be claiming Social Security in 2 years as well. Okay, this individual has $3 million in a 401k plan, and they have I said $1 in a taxable account. I think it's $1,000, so let me do this. I'll fix that while you wait. Just a moment. $1,000. I need to save that, by the way, in case I need to pull this up again. Won't make the mistake again. Okay, so we have $1,000 in a Roth account and $1,000 in a taxable account. I have set all portfolios to be conservative pre and post-retirement because we don't want to get into changing asset allocation in portfolios, because what we want to do is really look purely at or solely at tax planning to see how we can grow these assets and hopefully minimize taxes. On the second case, though, I do actually bring in let's see, I believe it's a moderate portfolio to show you how just increasing from a conservative to a moderate portfolio can have huge difference or tremendous difference. on the ending balances. And I did pull that in the last part of this discussion, so you can see that. So let's go ahead and take a look again. The CMAs, we're going to be using the historical, I believe. Yes, I have the historical CMA numbers that we're using, which of course is those higher historical rates. I'm also showing you some portfolios here. I'm showing you a conservative portfolio and, well, actually the reverse. Here's the aggressive portfolio, an 80-20 portfolio, and a 20-80 portfolio. And just to show you how the assets differ between those. Again, I'm not going to be using this aggressive portfolio. We're going to be sticking to conservative, both pre and post retirement. So in order to find the optimal tax strategy, we would go over to the tax tab on the Wright Capital software, which is here, this tab at the top of the page, and then you would drop down to the tax strategies tab. And so what I've done is I actually did a screenshot of that, and I wanted to show you all of the options that are available for optimization. So as you can see here, for asset location, there are several options available. For the withdrawal sequence, do we go taxable, tax deferred? Do we go taxable, tax free? Do we go taxable, pro rata? As you can see, a number of different options. And so basically, it's virtually impossible to kind of work all of this out in your head. So you use the software to optimize that, and you'd click on the strategies and tell it to optimize, and we would come up with a solution or a proposal. So what we've done is, first I got a baseline. I took a baseline shot just to see, without any strategies, how do things look under the current portfolio. And as you can see here, we're looking at an ending asset number of $3.3 million, roughly, 3.3 million here. And I have lined it up, the current and the proposed, to be the same. So I haven't done any planning yet. That's why these bars are exactly the same here. Forget these two because they're getting into areas that really are not relevant to our discussion. But here, we're basically looking for, did this portfolio survive? And what's the size of the assets in the portfolio? So the current plan, or the baseline plan with no planning, was $3,327,000 at the end of the run. At age 95, that's how much was remaining in the portfolio. Next, you would go to the optimizer and tell it to optimize the allocation. And let me see if I can pull that up very quickly. Here we have tax strategies, and then as you can see, an additional set of tabs here. You would click on strategies, and then you would tell it to calculate or to optimize, and it would come up with 4 or 5 recommendations of allocations, and it would tell you how it would recommend that you have the drawdown strategies. And so that's what I've done here. And as you can see, we have what changed here. The asset location strategy changed. It changed from, I think it was pro rata. Let's go back to the previous page. What was it on the previous page? It was pro rata on the previous page. And so now it has changed it to taxable, tax-free, and tax deferred. Same goes for the second one here. The asset withdrawal strategy changed from what it was on the previous page to the allocation that it has here. And the net result of this is that the net assets went up to $4,071,000. And so that's the number, that's the green bar here. As you can see, with the strategy, we increased from the baseline, increased the ending assets. Okay, how much? By some almost $750,000, based simply upon the reallocation of the relocation of assets in tab number 1 or line number 1, and the withdrawal strategy changed in the second line here. One other thing that was done here is we did have some conversions that took place. As you can see here, I have an IRMA threshold planning that took place. The optimizer said we're bumping up against an IRMA surcharge threshold, and so we need to do some conversions to try to keep us below that threshold. And so what we did is set this bar, a slider, as it had recommended that we do, and reran the plan. And so it uses that IRMA planning to also optimize the portfolio to arrive at this $743,000 of increase. So 3 different things happened here. Asset location change, asset withdrawal strategy was changed, as well as some IRMA thresholds were reviewed, and they determined that they need to fill up the bucket up to a certain threshold but not go beyond that. and that was also and that ended up with some Roth conversions. And so money ended up in that Roth account. That's the account that I set up with $1,000 in it. I said some money may be coming over to that. And so that's what happened here. I gave room for that to happen. And when the proposal said do this, we told it to go ahead and do those conversions, and it did. And we had an increase up to $4,071,000, up from $3,300,000. That is a huge jump, $700,000 plus, simply because of the way that we're configuring our asset location and our drawdown strategies and Roth conversions that are taking place. Three different things resulted in $700,000 plus being added to the plan. There is one more planning point that we need to discuss here, and that has to do with estate planning or legacy planning. As you know, when people pass away and they have assets remaining in their IRAs, their 401k plans, or taxable accounts, those are typically, they go somewhere. But if the individual is a child, a spouse, an heir, a human being that's receiving that property, they would be considered an inheriting heir to the property. And so as we discussed back when we talked about RMDs, there is a forced distribution that takes place. It's been greatly condensed under some new laws. And so now that property has to be distributed within like 10 years. Especially if you're a non-spouse, you have a 10-year period of time that you have to deplete that account. Now imagine what it would be like to have brought into your income, you're working, you may be at a high tax bracket anyway, and then you inherited some property and you have to start adding on RMDs from that property over the next 10 years, or if not over the next 10 years, at least all of it in the 10th year. I mean, it all has to come out one way or the other. And so could be incredible taxes that would apply to the heir. So for estate planning purposes, a lot of times the person who's leaving the estate will go ahead and recognize or do conduct some additional Roth transfers to get that money into a Roth or a tax-free account so that the tax hit will not be as great when it gets to that heir. Not only are they able to engage in Roth conversions and have more tax-free money go into the heir over that period of time, not have it taxed when they do take the distribution, but it also can reduce the account owner's estate, the person who's leaving the property, the person, your client, who may have $3 or $4 or $5 million. If they have an estate tax problem, and estate taxes can run 40% or more, 40% tax on your estate, that's a huge amount coming out. Well, why not use some of your assets today, engage in some conversions, reduce the size of your estate, and not have it hit at that 40% estate tax bracket. And at the same time, you're moving tax-free money into your heirs' account. So two benefits from doing some estate planning. And what allows you to do that is this bar at the bottom of the page. And it says it's the estimated terminal tax. That would be the tax rate. That's the question that's happening here is they're saying, what do you think the tax bracket will be of the inheriting person? And so if you put 22%, 30%, 35%, the system will then optimize based upon what the receiving beneficiary is going to receive, what their tax bracket is going to optimize your client's account to have the proper conversions in order to kind of optimize the amount of tax-free money going to them. So fairly sophisticated program. A lot of good planning can take place in this tax section of the program. Okay, so now let's move on to the second case. Remember, in the first case, we had one major account, a 401k plan, which had $3 million, and we had to try to find a way to avoid those massive RMDs from hitting us down the road. And so not only did we change the drawdown strategy, the order of withdrawals, but we also did some Roth conversions along the way to try to smooth that tax marginal tax bracket over their lifetime. Here we have three accounts, as you can see on the right here: 1 million, 1 million, and 1 million. So there was some upfront planning that was done earlier, and so now we have some nice assets in each of those tax buckets. So looking at these charts, what I've done is I have, as I did before in the earlier case, I set a baseline case to where the plans are exactly the same. I have the current and the proposed being exactly the same. So I'll at least know that all the parameters are set correctly, or between the two. I don't have variables that are different in the current versus the proposed. And then we'll go over to the tax analysis software and ask it to optimize. And once it optimizes, it'll come back with a recommendation. And just as in the other cases, you can see here, it came up with a strategy, but the strategy is different this time because we have a different mix of assets. And so where we had a pro rata asset location, here they've broken it down, what was it say, tax-free, taxable, and tax-deferred. And then they have also changed the order of the withdrawal strategy from the standard default. They've changed that to taxable, tax-free, and then tax-deferred, and it was the opposite of that here. Also, should there be any Roth conversions? Well, we already have a Roth account that has $1 million in it. And of interest is that when I look at the conversion line here, there are no recommended Roth conversions. So they're okay with the accounts with strictly the changes to the asset location and the recommended withdrawal strategy, or the sequencing of withdrawals. They changed that up. And when we did, we came up, look at this, almost $1 million of additional assets or ending assets as a result of that change that was made. So isn't it amazing? I mean, to me, it's amazing that on our own it would be very difficult to run the numbers to try to figure out exactly which strategy may be the best, because as we saw on a previous page, there were probably 7 or 8 different ways you could configure the mix. And so this system, this and other systems like this, when you tell these systems to optimize, they look for the best mix of drawdown strategies, Roth conversions, you name it. And in this case, we're able to build out another almost $1 million of retirement assets for this individual. Well worth the time of the wealth management advisor or CPA or whoever is running this program from the client. I think the client would be happy to pay the fee that would be charged if they could come up with $1 million additional dollars. And so I thought that was a pretty nice result there. Okay, so the tax tab is an excellent place to do some planning. In addition to that, though, there is the retirement tab, and let me show you where that is, and then I'll go there and show you a few items. So we have the tax tab here, where we ran some numbers with tax strategies and looked at our results there. But you can also go over to the retirement tab and work with a few other scenarios. And so when we go over to the retirement tab, let me pull up my PowerPoint again. There we have it, the case that we're actually working on now. That was another case below. So we look at that tab, and as you can see, the probability of success, meaning that is this person likely to make it throughout their retirement and have assets remaining at their death? And the answer is yes, a 97% confidence rate. So when you run the numbers, they're looking very strong here. Here's the current plan, by the way. Here's the current plan, and the account is showing a $6,700,000, I think, is the amount listed there, if I'm reading that correctly. Okay, so now let's go over to the retirement tab and take a look at it from a Monte Carlo standpoint. By Monte Carlo, what we mean is there are these systems, this and other engines that are used for retirement planning, will run 1,000 scenarios. And what they're doing is they're running the numbers, the expenses, the assets, running the goals, everything that went into this plan. They're going to test that or stress test that using a Monte Carlo analysis. And so what they do is they say, based upon the portfolio allocations that you have in this plan, let's look at these portfolios and see how they can survive or how well this plan does when markets go up and down. And so there'll be a sequence of returns that happens over 1,000 trials. And every trial will be a different set of market conditions. 1,000 times they run this. And so what they will then do is they'll rank order those from the highest success, what amounted to the largest amount of ending assets, down to the lowest amount of assets, just assuming the markets just crashed in early years, never really recovered, all types of scenarios. And so 1,000 trials are run. And so what Monte Carlo will do is it will then rank order those from the highest to the lowest ending balance. And they'll strike it right at the 500th number, okay? So halfway between the lowest and the highest. That's the number they grab, and that's the median. And this is what you're looking at here, the median number. In fact, if I were to go to this page, this is giving you an example of what a Monte Carlo simulation would look like. As you can see, the highest number, it doesn't, I don't have it printed out here, but this number up here, which is close to what, almost $20 million for the high, and then down around less than $1 million or so for the low. So that's the range of possibilities. But at the 50th percentile, meaning at the median strike point, halfway between the lowest and the highest, that number amounted to, in this particular run that I did, $7,500,000. And so using a Monte Carlo simulation, it is likely that using the portfolio design that we had, this individual would end up with $7.5 million at end of life. And so that's what Monte Carlo is used for. And the reason I mention that is it's not the same as the numbers that you may see in the tax analysis. And we're not going to get into the weeds here other than to say the tax analysis uses a straight line or a linear calculation. It just says the assumed rate of return on this portfolio is 7.8%, and it'll use that and it'll calculate out over the person's lifetime using that locked-in linear rate, that compounding rate. Monte Carlo looks at all types of market conditions and comes up with a mean, which is the halfway between the lowest and the highest number that was achieved in all market conditions. And so those numbers may vary, or they will vary when you look at the two between the tax section and the retirement section. But let me back up again and just let me show you how we can use this retirement section, okay? So here we are again. As I like to do, I set up the baseline scenario where I have the current and the proposed being the same. And so we have $6.7 million, I believe. Let me see if I can, I don't know if I'm in the way or not, but anyway. $6.7 million is the Monte Carlo run. That's what they came up with. That was the median they came up with. And successful, right? 97%, 97%. And so what we can do now, though, is look down at these options to change things and see what would happen if we made those changes. And I just made one change to give you an example of what can happen here. I went down and said, you know what, that's tax strategy we looked at on the tax page. Looked pretty good. I like that scenario. So I'd like to switch to that proposed portfolio, which had that tax strategy built into that. And so when I did, I said, at the drop down here, tax strategy, I clicked proposed strategy, reran it. And as you can see now, we're looking at, again, a Monte Carlo simulation. It runs 1,000 trials, and it too shows that your account balance is larger, $7.5 million compared to $6.7 million under the current plan that didn't have any changes at all. So again, looking at it both from a tax standpoint as well as from the Monte Carlo standpoint, where we stress tested in all market conditions, we're ending up with a really nice ending account balance here. I will not spend a lot of time on this slide other than to say this explains how the Monte Carlo simulation works. I went over it briefly a minute ago, but here it is in writing. And also there's a video. If you have this on a slideshow, you can then click the video and you'll go directly to a Wright Capital short webinar, like 2 or 3 minutes, that explains essentially the same thing on how to read this chart. Okay. Finally, I did add one more item just for your review, and that was where I told you we were going to move from a conservative portfolio and simply go to a, I think it was moderate. I believe I changed it to a moderate portfolio. Let's see if I have it down here. Yes, here it is. Retirement allocation. So not only did we adopt the proposed strategy for tax purposes, which is down here, use the proposed strategy, I also went up and I changed the portfolio to, instead of being conservative, I took it to moderate with a little bit more risk and a little bit more return. But I think it'll interest you to see the balances that resulted from that. So to show you that, let me move myself out of the way here. With the moderate portfolio and employing, bringing into play the proposed strategy, the tax strategy, the ending median portfolio increased to more than $15 million. So are we saying it did double, right? $7.5 million was the portfolio with the tax strategy, simply by going up from conservative to moderate portfolio allocation, we doubled the size of the portfolio. So when it comes to discussing risk and returns with clients and their risk profile, their risk tolerance, there can be a huge difference in their success or failure depending on the portfolio that's adopted. Now, what we can't do as advisors is to go outside their risk tolerance, because that would be wrong. It'd be malpractice to put a client in a position where they can't stomach the risk. They don't have an appetite for the risk, yet you're putting them in a portfolio that does that. That's not suitable for the client that you would do those things. So, but having that discussion, I think is important, just to show how that if we mix things slightly differently, perhaps we can achieve some greater returns and maybe have more success. But again, just switching from conservative to moderate greatly increased the size of the ending balance there. Okay, that's all for this discussion. That is all we're going to discuss in terms of allocation, asset location, and withdrawal strategies. So we're done. Thanks.